Hi, welcome. Introduction to Accounting. My name is Raj. I will be your instructor. So, I'll give you background on myself. I have a Bachelor of Business Administration with a concentration in accounting. I've articled with a Big Four firm where I obtained my CPA CA designation, and then I worked in both public and private companies, specializing in mining, retail, and private services. So today's learning objectives, we're going to talk about what is accounting? What is its purpose? What are the different forms of business organizations? What are the financial statement elements? What is the accounting equation? And then we'll also go over financial statements. So accounting is everywhere. It is known as the language of business. It essentially evaluates a company's financial performance. It's a systematic process that identifies and records economic transactions. It will then summarize and report the results to its users. And who are the users? Well, we have both internal and external users. Internal users are those inside the business, and external users are those outside of the business. So those would include creditors and investors. So creditors are those that lend money to the business, such as banks, credit card companies, private lenders, and investors would include owners or potential owners. So financial activities are communicated in the form of financial reports. So external users will look at these reports and determine whether or not they should invest or lend money to the business. The financial statements help to make these decisions. So, financial statements, what are they? Well, they're going to give us information on the company's assets, liabilities, profitability, and cash flow. Assets, what do we own? Liabilities, what do we owe? Profitability, how much money have we made? Cash flow, how have we spent our cash? Now, business organizations can take many different forms. The common ones are proprietorship, partnership, and corporation. So, proprietorship is a business owned by one person. A partnership is owned by two or more persons who are associated as partners. And a corporation is a business that is incorporated as a separate legal entity. So we'll go over each one in a little bit more detail. So sole proprietorship has unlimited liability. So that means the owner is personally liable for all the debts of the business. And that means that the owner will take the risk of all the profits and losses. Generally, these businesses exist in a small capacity. A partnership, on the other hand, has more than one owner, is commonly in service type businesses, which will include professional practices such as lawyers, accountants, and doctors. Corporations will have their ownership divided into shares, so they will have multiple owners. The owners are known as shareholders or investors. There's unlimited life and limited liability. So, types of corporations, we have public corporations and private corporations. So, public corporations, the public can purchase the shares. The financial statements are available to the public, and shares are listed on a stock exchange. So, in Canada, that would include the TSX, TXXV, and the CSE. Private corporations, on the other hand, do not issue publicly traded shares. The financial statements are also not publicly available. So, what are the financial statements? These are the main four financial reports that are produced for users. The first one is the balance sheet, also known as a statement of financial position. The second one is the income statement, known as the statement of profit or loss. We then have the statement of owner's equity, and then the cash flow statement, also known as the statement of cash flows. So the balance sheet template looks like this. We will have the header at the top with the company name, statement name, and specific date. And the specific date is usually at the end of a month, quarter, or year. And you will see the company's assets, liabilities, and owner's equity. And now here you can see where it says assets equal liabilities and owner's equity. This is essentially the accounting equation, and we will come back to this. The balance sheet elements consist of assets, liabilities, and owner's equity. Assets are those resources that are owned by the company. They have a future economic benefit. Liabilities are the financial obligation or debts that are owed to the third parties. And owner's equity is then the net claim on the assets of the company, and it will equal assets less liability. So similar transactions are grouped into accounts. Accounts have specific titles such as cash, and then the individual account will keep a record of all the increases and decreases to its balance. So the type of accounts that exist in assets will include items such as cash, inventory, supplies, property, plant, and equipment, prepaid assets, and accounts receivable. So all the specific transactions related to a specific account are recorded into its own account. Accounts for liabilities include accounts payable, accruals, deferred revenue, wages payable, loan payable, and notes payable. Owner's equity will contain the accounts such as owner's capital, owner's drawing, and income summary. So after the balance sheet, we then have the income statement. So the income statement header you'll see will have the company name, again, the statement name, which is income statement. And now instead of being at a specific date, it's actually going to cover a specific time period. So it's going to cover a beginning and end. So that can be a month, a quarter, or a year. And it's going to report on the economic performance of the company by reporting on the profit or loss of the company. And that is essentially the revenues less the expenses. And then that will give us either a profit or a loss. So let's look at these income statement elements a little bit more closely. So what are revenues? Those are income that are generated from business activities that are undertaken to earn profit through the selling of goods or services. Expenses, on the other hand, are costs. So cost of assets consumed and services used in the business activities. Now, if we look at the specific accounts that exist under revenues, that may include fee revenue, sales, service revenue, interest revenue, and rental revenue. Accounts under expenses will include items such as office expenses, payroll expense, accounting and legal expenses, marketing expenses, supplies expenses, and depreciation expense. Now, the difference between revenue and expenses will either equal profit or loss. Now, profit is what results when revenues are greater than expenses. Generally, we want a profit, but losses can also happen. That's when revenues are less than expenses. Statement of owner's equity. So, like the income statement, it will also have a heading. So, company name, statement name, and it's going to cover the same specific time period as the income statement. It starts off with beginning owner's capital. We will add in investments, add in profit, and subtract any drawings. And then we will have an ending owner's capital balance. So what are investments? So an owner may contribute to the company in form of cash or other assets. So it would then increase the company's assets and also increase owner's equity. Profit will also increase owner's equity, but if there's a loss, that will decrease owner's equity. And then drawings. Sometime owner will withdraw money from the company for personal use, and this can be in the form of cash or other assets. So let's go back to the accounting equation. So this was mentioned when we went over the balance sheet. So the company's assets will always equal its liabilities plus its owner's equity. Now, this accounting equation can be expanded upon when we factor in revenues, expenses, drawings, and investments. So owner's equity will encompass those individual accounts. So we will have owner's capital, okay, minus drawings plus profit or loss. So the accounting equation must always balance. When we look at transactions, we first need to determine, is there an accounting implication? Then we need to determine the accounts that are affected and determine the amount. Now let's go back to what is an account. Now it's a specific asset, liability, owner's equity, revenue or expense item in which transactions are recorded as an increase or a decrease. Each account has a unique title, such as cash or accounts payable. Now, the dual effect of transactions. Every transaction will have a dual effect on the accounting equation so that the two sides of the equation will always remain equal. So let's look at the accounting equation. So if an asset is increased, there needs to be a corresponding increase in a liability. Or the other option is to have an increase in, and there's still another option with a decrease in another asset. Now we're going to look at some transactions to show you how the accounting equation is always in balance. So let's say we have a company called Joey Professional Accountants. Now, Joey is my dog and she's a professional accountant. So in the very first transaction, the owner, Joey, invests $15,000 cash into the business. So you'll see our assets will increase. So our cash account will increase by 15,000 and owner's equity will also increase. So Joey C capital will increase by 15,000. Okay, so we have 15,000 on both sides. Now our second transaction is that the company will purchase $10,000 worth of equipment for cash. So cash is now going to go down by 10,000, but equipment is going to go up by 10,000. So from an asset side, we will stay in balance. So now our cash will have 5,000, our equipment will have 10,000, and owner's equity will stay at 15. So both sides will have 15,000. Now, our third transaction, we're going to purchase some supplies on credit for $1,000. Now, when we say on credit, that means that we will buy it and we won't expend any cash. We will then owe someone money. So our supplies will increase by 1,000. And because now we owe someone money of $1,000, our accounts payable will also increase by 1,000. Now you'll see we have cash of 5,000, supplies of 1,000, equipment of 10,000. So on the asset side of the accounting equation, we now have 16,000. Now, if we look at our liabilities, accounts payable, we have 1,000, and owner's equity, we now have 15,000. So we are still at 16,000 on the liabilities and owner's equity side, and therefore still in balance. So now our fourth transaction, we have cash sales of 1,500. So we sold something and we got cash 1,500. Cash is going to go up by 1,500 and revenues are also going to go up by 1,500. Now revenues increase on the owner's equity side. So now if you look at our accounting equation, we have 17,500 on the asset side and 17,500 on the liabilities and owner's equity side. So transaction number 5, we purchase some advertising, which is an expense for $1,000 on account. So again, on account means that we don't use cash. We will owe a vendor money. So accounts payable is going to be the affected account. So we will see accounts payable increase by $1,000 and expenses decrease owner's equity. So they will go down by 1,000. So essentially now if we look at the accounting equation, we still have 17,500 on the asset side. And then in terms from the liabilities and owner's equity, the $1,000 increase in accounts payable will be offset by the $1,000 decrease resulting from the advertising expense. So we will still have 17,500 on the liabilities and owner's equity side. So in terms of the transaction summary, we have to look at each transaction and analyze its effects on the 3 elements: assets, liabilities, and owner's equity in terms of the accounting equation and the specific accounts within each element. The 2 sides of the equation must always be equal. So assets equal liabilities plus owner's equity. So now we're going to look to see how the financial statements are all interconnected. So first, we always want to prepare the income statement. So the income statement will always have the following heading: company name, statement name, and the time period it's covering. It's going to include revenue and expense data. So revenues will appear first, and then they will be followed by the list of expenses. The profit will then be determined. So this is an example of Joey and Company's income statement for the year ended December 31st, 2024. You will see we have service revenue of 45,000 and then a list of expenses that total $21,750. So then we will have profit for the year of $23,250. Now this profit is going to flow into the statement of owner's equity. Okay, so the statement of owner's equity will also have a heading, so company name, statement name, and the same time period covered that is covered by the income statement. As discussed, the beginning owner's equity is shown on the first line. Now this balance will equal the ending balance from the previous period. Owner investments are then added to that balance. Profit will increase owner's capital, and any losses and drawings will reduce owner's capital. So if we look at Joey and Company's statement of owner's equity for the year ended December 31st, 2024, we can see that we start off with Joey's capital balance from the beginning of the year, January 1st, 2024. We add in the investments and we add in profit for the year. Then we subtract the drawings, and then we will have an ending balance. So Joey capital at December 31st, 2024. Okay, and then that number is 78,250. Now this number will flow into the balance sheet. Okay, so the ending capital balance flows into the balance sheet. So the balance sheet will also have a heading, so company name, statement name. Now note the balance sheet is going to be at a specific point in time, so it's a specific date, and it's going to be the end of the time period covered by the income statement and statement of owner's equity. Assets are listed first, then liabilities, and then owner's equity, but other orders are also possible. Okay, the accounting equation must hold true, and that total assets must equal total liabilities plus owner's equity. So Joy and Company's balance sheet, so you'll see the header and you'll see the specific date is now listed at December 31st, 2024. All the assets are listed, such as cash, accounts receivable, prepaids, property, plant, and equipment. Their total and our total assets you can see are 82,500. Now we'll look at our liabilities and owner's equity. Okay, so we have accounts payable and notes payable as our liabilities. The total of that is 4,250. And then we will have our Joey capital balance from December 31st, 8,250. And our total liabilities and owner's equity equals 82,500. Now you can see the accounting equation holds true here. Our total assets equal our total liabilities plus owner's equity. After this, we can then prepare the cash flow statement. However, this is beyond the scope of introductory accounting, so we're not going to discuss this in depth. Now you can see our summary here of the financial reports. We first always prepare the income statement. From the income statement, we will determine the profit. That profit will flow into the statement of owner's equity to determine our ending owner's capital. And then that balance will flow into the balance sheet, and our accounting equation must hold true, and assets need to equal our liabilities plus owner's equity. Thank you so much for listening today on introductory accounting. So what's next? Well, stay tuned for our next lesson where we discuss debits and credits, journal entries, the general ledger, and the trial balance. See you then.